Time now for Financial Focus, and today we're talking about interest rates. Car loan rates, mortgage rates, the general cost of borrowing is going up, and joining us to talk about it is KTNV financial analyst Steve Budin. Steve, thank you so much for being here with us.
Good morning.
So tell us, why is the Federal Reserve raising interest rates?
The Federal Reserve is our nation's central bank, and they're seeing what we're seeing out there with costs of living going up, inflation. And in theory, what they're trying to do is slow our economy down. So by raising borrowing costs, whether it's car loans, business loans, mortgages, what they, in theory, are trying to do is slow things down. So somebody may not buy that car. Somebody may not build a factory. And by slowing the economy down, economic activity slows down, and that should bring down the cost of doing business and lower inflation. And the Federal Reserve has basically indicated that starting next month, they will begin to raise some of their target interest rates, which then filters through the economy to all of us.
So what does this mean for our saving accounts? A lot of people are still trying to save and prepare for the future. So are we going to see these higher rates in our saving accounts?
In theory, we should. Of course, it's no surprise. The borrowing costs will go up really quickly. The savings accounts tend to trail them. So they should trickle up over time, but it won't be instantaneously. But if our viewers are willing to put in a little bit of work, there are savings alternatives out there that are getting more and more competitive. Things like, treasury bonds and annuities, and some online banks are actually offering pretty attractive and competitive interest rates. So you should begin to see those go up from basically zero over time, but it won't be as quick as the mortgage rates or the car loan rates.
So for somebody who might have some outstanding debt, what is the advice for them?
Yeah, somebody who has a car loan or a mortgage right now, those rates are pretty locked in. But if you have credit card debt, consider making some additional payments, because the average credit card right now is north of 16% interest. Those rates are going to head towards 18 and 19% potentially. Those interest rates can really hurt our viewers. So instead of making minimum payments, do whatever you can to make some additional payments, and you can pay down that debt even faster.
Great financial advice and information you gave us there, Steve. Thank you so much for joining us.
You're very welcome.
And we'll be right back after this.